Like, it's not that crazy. I'm not saying they should do it. I'm just saying that as an observer, not a predictor, as an observer, they have to do it. And so once you start to understand that, you say, literally, think of something worse for the economy than we are going to lock everyone in their homes for months. The velocity of money ground to a halt. People were selling asset prices. Bitcoin dropped 50% in a single day. What else could you possibly come? The dinosaurs going to come back? Are aliens going to visit us? Is a comet going to hit Earth? Like, to think of like whatever crazy thing you could think of. It's probably still not worse than we're going to lock the entire country in their home for months. And so if you say to yourself, okay, if it can't be worse than that from what could happen to the economy, and we know what the response is, they're never going to let the asset prices go down for a prolonged period of time. Doesn't mean asset prices can't go down, but if you're a young person and asset prices go down, you're like salivating. You're just like, just buy more because these idiots are going to just pump the prices back up. And so that's, if you go back to 2020, that's what the smart people did. Asset prices fell, they didn't sell anything, and they just bought more. And by the end of the year, we're back to all-time highs. Genius.
Anthony Pompliano contends that the emergence of Bitcoin and other cryptocurrencies indicates a fundamental change in our perception of value in money, not merely a technological advance. Because of the growing need for decentralized assets and mistrust of centralized institutions, Bitcoin has become a hedge against traditional financial systems during the last 10 years. Pompliano contends that Bitcoin is among the most groundbreaking financial inventions in history due to its fixed supply, decentralized structure, and expanding user base. Please take a moment to like this video, subscribe to the channel, and enable post notifications for more similar information before we delve deeper into Anthony Pompliano's thoughts. Remember to see our other videos about digital assets, blockchain, and cryptocurrency. Thank you, and enjoy the video.
I think that investors finally realize the game has changed. If you go back and you look at the last 16 years since the global financial crisis, the Fed has stepped in and they have broken the financial market in terms of how it used to work. It no longer works the same way. And so investors, I think, kind of felt this. They had a hunch, they had a hypothesis that this was true. But in 2020, we proved it to be true. Because what investors felt through the 2010s was every time we get near a market crash, every time we get near a market downturn, every time we get near a potential recession, the Fed seems to become a little bit more aggressive. They begin to intervene. They begin to stimulate the economy. And so the central bankers invented this brand new tool called quantitative easing, where they were going to simultaneously suppress interest rates and they were going to print money. Now, when we get to 2020, we get to test. You had a hypothesis, but now we're doing the scientific process, and we're going to test the hypothesis. There is no cleaner test than lock everyone in their homes and don't allow their businesses to operate. That's a pretty big crisis. And so what happened? Fear spread like a true virus. And all of a sudden, everyone was like, oh my God, asset prices are going to fall. And people just started selling everything. They're selling stocks, bonds, crypto, anything they possibly could, and they wanted dollars. In that moment, the Federal Reserve had to show their true colors. It's kind of like at the end of a poker hand, you got to lay the cards out. What are you holding? Right? Either you put up or you shut up. And when they laid their hand down, it was exactly what investors had hypothesized about, that the Federal Reserve will not allow the market to have a prolonged bear market. The Federal Reserve is going to suppress interest rates and print money, and they are going to ensure that asset prices continue to go up and to the right. And so that's what we did. 2 emergency rate cuts down to 0% interest rates, and we printed trillions of dollars. That one moment of 2020 of actually confirming what investors already thought told every single investor one message: get the hell out of the safe zone and push out on the risk curve. And so I now believe that it is nearly impossible in the United States of America for us to see an 18-month or longer downturn. We can have 3 months, 6 months, maybe even 12 months. If you go back to 2020, we saw stock prices go down for about a year. They started to go down in the beginning of 2022, and they bottomed by the end of the year. And so then we went back up. October of 2022 was the bottom of the stock market. If you look at crypto, similar thing. I think it was like November, December was the top of the market. In 2021, by November of 2022, bottom, we go back up. And so we didn't even really get a full 12-month market downturn until we bottomed. And so I don't believe that we can get 18 months or more. Why? It's because we are addicted to cheap capital. We have to have that capital coming in. Now, what's fascinating about this experiment in 2022 was that they kept hiking interest rates, but asset prices bottomed and went back to all-time highs. So even though interest rates went to over 5%, we still got all-time high in asset prices. Why? Because the Federal Reserve got overwhelmed by the fiscal policy of us printing hundreds of billions of dollars that then got pushed into the market. And so when you look at this, you say, wait a second, the Federal Reserve is in a position where they have to cut interest rates, keep them suppressed, and print money through quantitative easing. But also when you add in the fiscal component, there's no way the central bank and the politicians are ever going to be on the same page. No way. Because they are all incentivized to do the same thing. So even when one corner of the inputs gets on the right page and says, hey, you know what, maybe we should chill out, we should raise interest rates and we should not print money, there's someone somewhere else who isn't on the same page and they're going to go and they're going to do it. And so investors now realize, just get long because they are going to make sure that stocks go up over the long run. Crypto goes up over the long run. All this stuff is going to go up. And so when you see a 30%, give or take year, you're like, that's a massive number. The NASDAQ was up 50% last year. These numbers seem like they are unsustainable. But if I told you that the market actually broke and it took until 2020 to 2024 for investors to realize it, and now we're just seeing the impact, why can't it happen again? People say, well, maybe the market crashed. Okay, maybe it does crash. But do you think 5 years from now, the stock market's at all-time highs again? Yeah, duh. Like, you would have a very hard time betting on a 3-year or longer time frame that the stock market is not higher than it is today. Has nothing to do with the stocks. Has everything to do with the structure of the market, the Federal Reserve, and the politicians. And so unless politicians, central bank all get on the same page and say we're not going to push liquidity into the market, it has to keep going up. And so that's basically the investment decision today. Sure, you can go and you can pick individual stocks, try to outperform the indexes, whatever. But if you just say, hey, I'm going to just do indexes or I'm going to do cash, it's like a no-brainer, right?
Anthony Pompliano boldly asserts that it is almost impossible for a bear market to continue 18 months or more in the current financial system. He supports this by citing the previous 16 years, which have seen no protracted downturn. Anthony asserts that such events are extremely unlikely due to the Federal Reserve's commitment to stabilizing asset prices. The market decline lasted less than a year before recovery started, even in 2022 when there were notable corrections. Because the financial system's design encourages ongoing intervention to keep markets afloat, he thinks this pattern will continue. Now let's get back into Anthony Pompliano's insights and learn how to navigate Bitcoin's highs and lows with a smarter strategy. Don't forget to like, subscribe, and enable notifications for more valuable content.
We should keep an eagle eye on both the price inflation and asset inflation. They did not do that. They were just worried about price inflation. And so that never showed up. In January of 2020, inflation was less than 2%. So a decade later, what happened during that period, though, was asset inflation exploded. And so these asset prices kept going up and up and up and up. And so that's where a lot of this showed up. But the Fed was focused on inflation in terms of price inflation. And so that kind of looking at price inflation and not paying attention to asset inflation, one, the wealth inequality gap widened because the rich people had the assets, so they benefited. But two is the Fed kept with the quantitative easing because they were like, well, there's no price inflation. There's no price inflation. Look, there's not a problem. And so I think that, kind of coming back to this quote, is the idea of asset inflation is amazing for the people who hold the assets. The question is, does the asset inflation stop? But if the asset inflation just continues, then there's no problem. And I think that's really the game here, is that asset inflation is something that nobody was really talking about because they had these other names, booms and busts and all the stuff. But how long does it have to go for? Right? Like I was talking to somebody that said, 18-month, bear markets can't happen anymore. They're like, oh, that's crazy. I was like, classic traditional guy. And I said, okay, well, it's been 15 years, 16 years, whatever it's been. How much longer does this have to happen before you say you agree? 20 years? If we don't get an 18-month or longer bear market in 20 years, do you agree? No? Okay, 25, 30, 50? Will you do it from your grave? Right? Like at what point do you wave the white flag? And again, it's not like we're talking about it's been 2 years, it's been 3 years. We're not talking about a decade and a half. And so I think that's really what we're starting to kind of talk about, is like the longer that this goes on, the more likely that the game has changed, that the market has changed. And so it just goes back to you can boil all this kind of, super nuanced, sophisticated finance stuff down to invest, don't save. That is really just the answer at this point. And what they realized was that the market is their boss. The Fed is not the boss of the market. So because the market expectations were that they had to go big, they felt like if they didn't go big, the market would be disappointed and asset prices would crash, which is what they were trying to prevent all along. And so market expectations dictate what the Fed does. And so now the Fed, they do these, they try to preview their current things. They're trying to influence whatever. But if everyone on Wall Street came together and had like a secret meeting without the Fed and like, yo, let's all just like tell them we're going big, the Fed would have to do it, right? And so if you go back to this optimism survey, if half or more, the doubling, like all this stuff, like there's more people who are optimistic and also they're super optimistic, well, guess what? The Fed's going to step in the market. The Fed's got to listen to the people. And so the people run the Fed. And so that's what I took away from that survey, is that now the Fed's like, oh, shit. If asset prices were to crash tomorrow, what do you think Fed's going to do? Like anything other than suppress interest rates to zero and print trillions of dollars looks like you're bringing a water gun to a gunfight, because that's what we're used to now, right? In 2020, like we breached the subject. When there's a crisis, put the interest rates to zero and print trillions. If you don't do that, you're not trying hard. Guess what? In my lifetime, I bet you they print $10 trillion in a crisis, right? And people are like, oh, that's crazy, whatever. Like, okay, well, did you think that they'd ever print 3? Like, it's not that crazy. I'm not saying they should do it. I'm just saying that as an observer, not a predictor, as an observer, they have to do it. And so once you start to understand that, you say, literally, think of something worse for the economy than we are going to lock everyone in their homes for months. The velocity of money ground to a halt. People were selling asset prices. Bitcoin dropped 50% in a single day. What else could you possibly come? The dinosaurs going to come back? Are aliens going to visit us? Is a comet going to hit Earth? Like, to think of like whatever crazy thing you could think of. It's probably still not worse than we're going to lock the entire country in their home for months. And so if you say to yourself, okay, if it can't be worse than that from what could happen to the economy, and we know what the response is, they're never going to let the asset prices go down for a prolonged period of time. Doesn't mean asset prices can't go down, but if you're a young person and asset prices go down, you're like salivating. You're just like, just buy more because these idiots are going to just pump the prices back up. And so that's, if you go back to 2020, that's what the smart people did. Asset prices fell, they didn't sell anything, and they just bought more.
Although inflation was less than 2% in January 2020, asset inflation was the main narrative of the following 10 years. The Federal Reserve ignored the expanding asset bubble and concentrated mostly on price inflation, even though asset prices were rising rapidly. As a result, there was a notable increase in wealth disparity among the wealthy who own these assets. Convinced that there was no actual inflation issue because price inflation was still low, the Fed maintained its quantitative easing policy at the same time. According to Anthony Pompliano, there isn't a serious problem as long as asset inflation keeps up, unless it stops. However, the issue will be ignored, and the wealthy will continue to profit if asset inflation continues to rise. Anthony concerns how long it will take for people to realize that the game has changed, and challenges conventional financial thinking by pointing out that there hasn't been a sustained bear market in the last 16 years. He contends that the market has undergone a fundamental change, and that the expectations of the market now directly influence the Fed's decisions. The Fed will act if the market feels that it must in order to prevent asset prices from plunging. The main takeaway from the video's conclusion is that the market, not the Fed, is in charge. The Fed's actions are influenced by the expectations of Wall Street and investors, so it will act if the market calls for it. Anthony emphasizes that since history demonstrates that the Fed would take action to drive asset prices back up, a market decline may actually present an opportunity for young investors to buy more. He thinks this cycle will continue, with the Fed intervening when needed to avoid a protracted slump and the wealthy profiting from asset inflation. And as always, happy investing.